Let's talk about a word that you're going to be hearing a lot more about. A word that could completely reshape how we own, well, pretty much everything. That word is tokenization. And today, we're going to break down what it is and why it's being called a revolution in finance. Let's get right into it.
So just how big are we talking here? The potential market size is projected to be $16 trillion. Yeah, that's a 16 with 12 zeros after it. It's a number that's almost impossible to wrap your head around, but it gives you a sense of the scale of the shift we could be looking at.
And look, this isn't just some random number pulled out of thin air. The Boston Consulting Group is predicting that the market for these tokenized assets could explode to that $16 trillion figure by 2030. So what on earth is a tokenized asset, and why do some of the sharpest minds in finance think it's the next big thing?
All right, so let's get to the heart of it. What does it actually mean to tokenize something? This is the core concept behind that giant $16 trillion forecast.
In the simplest terms, tokenization is taking the ownership rights of a real-world thing, like a building, a piece of art, you name it, and converting them into a digital token that exists on a blockchain. Here's an easy way to think about it. Imagine a huge skyscraper in the middle of a city. Instead of one company owning the whole thing, you could digitally slice it up into, say, 1,000,000 tiny pieces. Each one of those pieces is a token, and owning that token means you own a verifiable slice of that building.
To really see why this is a potential game changer, let's do a quick before and after. Traditionally, big assets like commercial real estate or fine art are illiquid, meaning they're super hard to sell quickly. Transactions can drag on for weeks, and let's be honest, access is usually limited to the super rich. Tokenization wants to flip that script completely. The goal is to make these assets liquid so you can trade them 24/7. Transactions could be almost instant, and access, well, it could be open to just about anyone.
Okay, I know this might sound incredibly complicated, but the process itself is actually pretty logical when you break it down. So let's walk through how an asset goes from being a physical thing in the real world to a tradable token online.
Okay, so first an issuer picks an asset. Let's say it's a rare classic car. Then, using what's called a smart contract, which is really just a piece of code that runs automatically on the blockchain, the ownership of that car gets digitally divided up. After that, these new tokens are issued onto a secure blockchain, like a public ledger. From there, they can be bought and sold on digital platforms, with every transaction recorded transparently. And this is key. The whole thing has to follow financial rules, like know your customer regulations, to keep it all above board.
So we've covered the what and the how, but maybe the most important question is why? Why go to all this trouble? Let's dig into the advantages that have so many people excited about this technology.
The potential benefits are pretty powerful. First up is accessibility, thanks to something called fractional ownership. All of a sudden, you don't need millions to own a piece of a venture capital fund. You could buy a small token. This makes things that were once hard to sell, like art, way more liquid. It also promises to be more efficient by cutting out a lot of the traditional middlemen, which should lower costs. And since it's all on a blockchain, it allows for seamless global trading and provides top-notch security, because the record of who owns what is transparent and can't be secretly changed.
Of course, it can't all be sunshine and rainbows. With any opportunity this massive, there are going to be risks. It is so important to look at this with a balanced perspective. So let's talk about how someone might get exposed to this trend and, more importantly, what you really need to watch out for. So if you are interested, there are a few different paths emerging. Some platforms let you buy tokenized versions of major stocks. You could also invest directly in the crypto projects that are building out this tokenization infrastructure. Another way is to invest in the foundational blockchains that this all runs on, like Ethereum or Solana. And for those who want broader exposure without picking individual winners, there are exchange-traded products, or ETPs, that bundle a bunch of these assets together.
But, and I can't stress this enough, before anyone gets too excited and jumps in, it is absolutely critical to understand the other side of this. This is brand new, cutting-edge stuff, and that comes with some very real risks.
The number one message here is to be careful. For starters, the regulations are still being figured out all over the world. The crypto market is, as we all know, incredibly volatile. Digital assets are a huge target for hackers. And ironically, even though the goal is liquidity, some of these new tokens might be hard to sell if there isn't a big enough market for them yet. And finally, the technology itself is still young and can have bugs. And all of this leads us to the final big question. The grand promise here is the democratization of ownership. The idea that anyone, anywhere can own a piece of anything. But when you factor in all the risks, is this a financial utopia in the making? Or is it just a new, more complicated set of problems? That right there is the $16 trillion question we'll all be watching unfold.